Ladies and gentlemen, good day and welcome to Omnitech Engineering Limited Q3 and 9 months FY26 earnings conference call hosted by Equirus Securities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Shah from Equirus Securities. Thank you, and over to you, Mr. Shah.
Thank you. Good evening, everyone. On behalf of Equirus Securities, I welcome you to third quarter and 9 months FY26 earnings conference call of Omnitech Engineering Limited. We are pleased to have with us management represented by Mr. Uday Kumar Parekh, Chairman and Managing Director, Mr. Paras Parekh, Chief Financial Officer, and Mr. Bhavin Acharya, Chief Revenue Officer. I will now hand over the call to the management team for their opening remarks, which will be followed by question and answer session. Thank you.
Thank you, Vaibhav. Good evening, everyone, and warm welcome to all the participants, and thank you for joining us today. Myself, Uday Parekh, I am a Chairman and Managing Director of Omnitech. As this is our first earning call, we begin by taking you through a quarter 3 and 9 months of financial performance. You may already have downloaded and reviewed the quarter 3 and 9 months of earning calls materials available on our website. Omnitech is involved in the manufacturing and supplying of high precision engineering components along with the assembly and serving to the global industries for the safety critical applications. Let me begin with the highlights of this quarter reflect the strength of Omnitech disciplined execution model. During this period, we also continue to strengthen our long-term growth platform. Our performance during this period reflects strong revenue acceleration by 80% over the quarter 3 FY25. Continued growth in our order book up to 2,900 crores. Meaningful expansion in profitability with EBITDA higher than 110% from quarter 3 FY25. Increasing a depth and value proposition product offering which enhanced our customer engagement, and steady progress on our capacity expansion roadmap. In parallel, we are actively strengthening our strategic roadmap with a focus push towards expanding our presence in the segments such as gas turbine, defense, aerospace. We believe this initiative will enhance our technological capability, supports margin improvement, and further aligns to our long-term strategic framework. We also believe that the evolving Europe and UK free trade agreement can create an additional opportunity for engineering components assembly requirements from the India, which can further support long-term demand for the companies with a strong precision engineering capabilities such as ours. Additionally, following the successful completion of our IPO, we have commenced to work on proposed manufacturing facility at Chhapra, which will significantly enhance our manufacturing capability over the coming years. Overall, the results reinforce our commitment to delivering profitable and sustainable growth driven by engineering excellence and disciplined execution. Recently, we have acquired 60,000 square meter plots in the GIDC Saran, located in Ahmedabad, which secures land availability for our future expansion plan beyond FY28. will offer us flexibility of manufacturing locations for new businesses that we are intent to do in our strategic industries domain. The implementation for this project will highly depend on business wins in the different new upcoming segments. With this, I would like to request Mr. Paras, our CFO, to walk through a financial performance. Thank you so much.
Yes.
Over to you, Paras.
Yes, thank you, Dev. Good evening, all, and warm welcome to you all. Let me take through the financial highlights for the quarter 3 financial year 26 and the 9 months ended December 25. For the performance of quarter 3 FY26 with the performance compared to the quarter 3 of financial year 25, our revenue from operations stood at INR 134.4 crores, registering a year-on-year growth of 81.6%. EBITDA for the quarter was INR 51.2 crores, reflecting a growth of 112.4% year-on-year. Profit before tax stood at INR 32.4 crores, representing a growth of 198.2% year-on-year. Profit after tax stood at INR 22.23 crores, reflecting a growth of 172.7% compared to the same quarter last year. Margins also expanded meaningfully during the quarter. EBITDA margin increased to 38.1% from 32.5%. PAT margin improved to 24.1% from 14.7%. PAT margin increased to 16.1% from 10.4%. The improvement reflects operating leverage benefits, better product mix, and disciplined cost management. Now, if we look for the 9 months financial 26 as compared to the 9 months financial 25 performance, then revenue from operations stood to INR 362.6 crores, reflecting a growth of 54% year-on-year. EBITDA stood at INR 121.3 crores, registering a growth of 62.3% year-on-year. Profit before tax stood at INR 69.3 crores, reflecting a growth of 132% year-on-year. Profit after tax stood at INR 50 crores, representing a growth of 113.6% year-on-year. Margins also stood improved. If we see the EBITDA margin improved to 33.4% from 31.7%. Profit before tax margin improved to 19.1% from 12.7%. PAT margin improved to 13.3% from 9.7%. If we see the return ratios, our capital efficiency continues to strengthen. 6 months FY26 ROC stands to 18.4% as compared to 16.1% in the financial year 25. 6 months financial year 26 ROE stands to 24.1% as compared to 21.6% financial year 25. If we see the 6 months financial year 26 net debt to equity, which remains stable to 1.7 times, improving significantly from 2.9 times in FY24. For 6 months financial year 26, our net working capital cycle stood to 256 days compared to 283 days in the financial year 25, reflecting a clear improvement in our working capital management. As we continue to scale, we remain focused on progressively optimizing this metric, supported by better process alignment, tighter controls, and enhanced operational efficiency. We are confident that through sustained operational excellence and disciplined execution, we will continue to drive gradual and consistent improvement in our working capital cycle going forward. If we see the overall, the company continues to maintain a healthy balance sheet while supporting growth investments. With that, I will now request Mr. Bhavin Acharya, our CRO, to take you through the business updates and order book positions. Thank you.
Thank you, Paras bhai. Good evening, everyone. Let me provide you an overview of our business mix and the growth visibility which we are seeing ahead. Looking at the revenue mix by industry, for the 9 months ended December 31st, 2025, the revenue from the operation stood at approximately 345 crores. From an end user industry perspective, the energy sector contributed roughly around 54%, Motion control and automation contributed around 27%. Industrial equipment systems contributed around 16%, and other diversified industrial application contributed around 2.6%. This diversified sector exposure allows us to capture opportunities across multiple industrial value chains. When we look at our revenue mix by geography, North America contributed roughly around 58%, India contributed around 20%, Asia contributed around 17%, and Europe and UK contributed around 4%. This diversified global customer base continues to support our export-led growth strategy. In particular, in North America, despite the evolving tariff environment, our positioning has enabled us not only to sustain but also grow our US revenue. This reflects the strong stickiness of our customer relationships, driven by the nature of our safety critical components, the long development and qualification cycle, which are associated with supplier onboarding, and our unique value proposition in offering higher value added precision engineered product across the value chain. Looking at that, if we look at the order book position, our order book is one of the clearest indicators of our growth momentum. The order book has grown significantly over the past few years. In FY25, we were at 283 crores, and as of March 11, 2026, our order book stands at approximately 2,910 crores, reflecting a strong order inflow and a long-term customer commitment. From September 30, 2025 till March 11, 2026, we have received multiple orders which have resulted in net order book addition of more than 1,200 crores. The multi-year Weatherford order further strengthens our visibility and reinforces customer trust in Omnitech's execution capabilities. To conclude, we believe Omnitech is in a strong phase of growth. We have a robust order book, diversified end market, a growing global customer base, and a manufacturing platform that is steadily being scaled for the future. We remain focused on disciplined execution, customer trust, and long-term value creation. On behalf of the entire Omnitech team, I would like to thank you very much for your continued support and confidence in us. Thank you for joining us today. We will be now happy to take your questions. Thank you.
Thank you very much. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. Ladies and gentlemen, you may press star and one to ask a question. First question is from the line of Vyom Daga from Valcore Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. So for my first question, if you could provide us a breakdown of who our top 5 customers would be and how much revenue do they contribute?
Yeah. So in the top 5 customers, we have Weatherford, we have Oscos, and similar another 3 large OEM customers. And our revenue stands below 30% off. So every month, like some percentage are floating, but it is below 25% around.
So none of the customers contribute more than 25%, right?
Right.
Okay. And sir, also if you could give us a breakdown of our top products. I understand we would have a lot of products, but if you can give us like the top 4 or 5 products and how much revenue do they contribute? And who would also be the major customer for that product?
Can you please repeat the question, please?
Yeah, if you could provide us a breakdown of our top 4 or 5 products and how much revenue do they contribute, and also who would be the top customer for that product?
Yeah. So as we are in a more on only customized product solutions, so we are around in the mandrel, similar to the torque tube and similar that, but it is also not contributing more than 7% of the revenue, top 5 also. So our product segment is not highly dependent on a particular product line. We have a very good diversified portfolio.
Got it. And just needed one clarification. So I believe we have a single order of around 1,030 crore from a single customer. So I believe this would be from the Weatherford product, right?
Yes, sir.
And what would be the execution timeline of this order?
So execution timelines are in between 3 years to 5 years. So we have a extended timeline. See, we can go up to 5 years, and minimum is 3 years.
Okay, got it. That's it from my side. I'll join back. Thank you.
Thank you. Next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Sir, there is a slight static from your line. Can you speak through the handset?
Now it's better.
Go ahead.
Yeah. Okay. Sir, thank you very much for this opportunity. So just wanted to understand the order book of close to around 3,000 crores, right? So what is the execution timeline of entire 3,000 crores order book?
So averagely, all the order books are executing timeline is the 3 to 5 years.
Okay.
And some order books are also trigger in a FY27, and you can say second H2 FY27. So overall, you can see it is a 5 years time plan.
Okay. Okay, understood. And we are very export dominated, right? I mean, close to about 80% of revenue comes from export, with majority from US, right? About 55-60%. So how are we seeing exports going forward? I mean, are we facing any kind of issue in terms of the export market?
Yeah. So presently in the shipping line, there is some few days of logistic time has been increased. But as we are working on a highest level of ex-works terms, so logistics and everything, customers are taking care of that. So we are not directly impacting from anything, but in terms of the logistic lead time, it has been increased around 7 to 12 days.
Only 7 to 12 days, that's it?
Yes, sir.
Okay, okay. And in terms of anything on your raw material, any kinds of cost escalation we are seeing, and do we import any kind of raw material?
Hi, this is Bhavin here. Yeah, yes, we do import material, but as of now, there is a marginal increase on the raw material, but there is no significant increase. And this is all passed through. So usually there is no direct impact as far as the raw materials are concerned. And a lot of materials are also being bought from India. So basically there is no as such raw material risk as far as the material is concerned.
And adding to the Bhavin's point, overall in our cost structure, materials contributes less than 30% of the total cost, average. So that is only the impact if there is anything.
Okay. Okay. So this 30% is what import as such, or the total material cost?
No, it's a total material cost in our overall sales revenues. It is average around 30%.
Okay, okay, understood. And just one last few things from my side. Now, given the strong order book we have, so and our revenue scale is still very small as compared to what order book we have. So what sort of growth CAGR we are looking at over next 2-3 years?
So it's a very good question. So historically, we were in around 35 to 40% of a CAGR growth in the previous few years. So we are anticipating and we are trying our having the same growth line in the coming year.
For next 3 years, I mean, similar kind of growth.
Yeah. It will again, apart from that, our expansions, what we are doing, that will enable us to leverage our sales revenue, accelerate our sales revenue.
Okay. But your current capacity utilization is already at 70%, right? And I don't think so. The new capacity is coming FY27. So what will drive the growth for us in FY27?
So if you see our presentation, so we have added in the present plant also, we have increased our capacity. Is around 40 to 50% of the, as compared to FY25, FY26, we have increased, and some of the increase we have done in the Q3 of this year. So that will enable us to grow our sales revenue.
So the increase in capacity in existing plant is to the extent of 40 to 50%.
Yes.
That we did in the Q3 of FY26.
Yes.
Okay. Understood. Yeah, that would be it from my side. Wish you all.
Yeah. Thank you so much. And so adding to that, in our IPO prospect, there are also some of our investment we have given into our existing plant, which will all add another some capacity in our existing plant.
Okay. I understood. Sure. Thank you.
Thank you. Next question is from the line of Daksh Jain from Sagun Capital. Please go ahead.
Hello, sir. Good afternoon. Sir, how cyclical is our business, especially the energy segment?
Pardon?
Sir, how cyclical is our business, especially the energy segment?
So this is Bhavin here once again. So if we are talking about the energy business, I think what we are looking at is probably, we don't look at it from the cyclic standpoint, because that is a continuous business what we have based on the area of business where we are. That is, we are a lot into maintenance, development, and operations. So that is a continuity of the business what we have year on year. And in fact, if you see the numbers, we have been growing regularly in that particular domain as well. So we don't see that business particularly cyclic. And also what we are looking at is that a lot of companies from the West, that is from North America or from Europe, are looking to diversify their manufacturing base in India, which is also gaining a lot of traction in overall business sentiment, and energy is one part of that. So we see a lot of that kind of traction coming in from various locations.
And adding to this, to Bhavin's point, our main most of product or many of the product goes into operation and maintenance side. So in the oil, whenever it comes with so many impurities like sand and so many. So after a few months or some time, that has to be a keep on replacing those parts. So that will also consistent volume in certain product line. So if you see, we have a very distributor portfolio in a O&M side also.
Okay, sir. So is it fair to say like we manufacture consumables, not one-time products?
Yes, exactly. Yes.
Okay. And sir, is there any component of job work in our revenues, like where we record only the machining charge and not the raw material?
So this is all our with material. We have a probably like a less than 0.5% or something like that. That can be in the job work side. Wherever customer have very stringent requirement of anything like a stellite or similar like that. So it is a very, very low.
Okay, sir. And sir, is there any any particular quarter that this is heavy for us in terms of accounting treatments?
Yes,
Can you repeat the question?
Is there any particular quarter which is heavy for us?
No, any it isn't.
Okay. And sir, last question, like, we have, very large margins, like 35% plus. So, to maintain that, do we have any, IP that which is, helping us maintain these margins?
Yeah. So we are into highly engineered products. So overall, in these industries, what we are serving into the critical in the nature and value-added product line. So these are the pretty overall average consistent margins we are operating in this business.
So I mean, like, if do we own the drawings and the CAD specifications that makes our product unique from the market?
So see, normally this is built to print. So overall drawing is given by the customer, but the complete engineering process that we have to do it into the Omnitech, and that is our USP for making how can we make the product more effective with all the technological implementation into the product manufacturing. So that is making us unique.
Okay, so lastly, can you explain your products in a bit detail? Like, we can't find any, catalog or something. So can you, describe the products in detail?
Hi, Bhavin here. So basically, when we talk about the products, basically we, as Uday bhai mentioned, that these are all built to print components and products for larger assemblies. So basically, when we talk about specific products, we don't have that kind of a specific product, but we do have products which are called as mandrails or tubing hangers or components basically for the actuator. So all these components would be used in specific product lines, be it on the hydraulic side, be it on drilling application side, and so on and so forth. So we are basically more on the machine components, welded assemblies, and those kind of things, which would be going into much higher assemblies or a bigger product line of the OEM. So if you look at our product line, we are not into a specific product because these are all built to print for various oil and gas or power or motion control and automation companies.
Okay, so thank you for answering my question.
Thank you.
Thank you. Next question is from line of Shomil Jain from Lucky Investment Managers. Please go ahead. Shomil, may I request you to unmute your line and proceed with your question?
Hello, am I audible?
Yes, go ahead.
Yeah, I just have a couple of data questions before I get to my other questions. First, in our RHP, we mentioned several raw materials, carbon steel, alloy steel, stainless steel, etc. If you could give a broad split in terms of, our COGS share of each of these materials. Second, is there any particular SKU that is a large part of our revenues? If yes, if you can quantify the share of that SKU in the revenues.
So in terms of average COGS, is raw material margin is 30% average of the product line. So and as we have discussed, we do not have any particular product line which are giving high revenues and everything.
Okay. And on just a clarification on my first question, I just wanted to understand what is probably the share of each of these raw materials in our COGS. How much is carbon steel? How much is alloy steel, titanium, stainless steel, etc.?
Yeah. So it is so we work across the many of the materials like a carbon steel, alloy steels, along with the titanium, Inconel, alloy, stellite, and similar. So every month there is some change on the percentage wise, but this is just high level of the philosophy. But you can say in the higher applications, the Inconel and titanium applications are more. So I presently I can we can connect offline, and I can pull out some data for the month on month and like that.
Sure. Do you have any broad split? I mean, I don't need exact numbers, but let's say for FY25 or 9 month FY26, any broad numbers? How much is Inconel, carbon steel, etc., etc.?
Yeah. So carbon steel, you can say roughly around 70%. But in the stainless steel category, there are 9 chrome, 13 chromes, and there are so many other variety, titanium, Inconel, and similar categories. This is just high level number, but I have to check again, the average of the year.
Yes.
Yeah.
And my final question, sir, you mentioned there's a lot of process engineering that you have to do even in the build to print sort of manufacturing that we do. Can you help us understand those process engineering sort of steps that you've taken and what allows you to make 80% or 70 odd percent gross margins? If you could just deep dive on some of the special processes that we have or have expertise in.
Yeah.
Okay. So let me add and one more question, what you mentioned about the SKUs also. So when we look at the business case, we look at the customers and their complete product basket and what value we are bringing to the table. So what we are trying, and you must have also seen the presentation where we have given the manufacturing capabilities. So what basically we do is that, we look at their product portfolio, looking at how many SKUs. Say as an example that one particular customer has, say, 400 SKUs. We work on basically those SKUs, start working on those different SKUs and build the product profile across the board with those particular customers. Having said that, we try to add value not only from the machining standpoint, but then we also have different capabilities. Like we have an API certification for special threading. We have surface treatment facility where we also add value by giving surface treatment to them. We also have welding capabilities, cladding capabilities. We are now doing assemblies. We are setting up testing capabilities in house. So giving them the entire solution, which makes us unique in delivering the complete sub assemblies and assemblies for our customers. Now, there were certain areas of application like honing, drip, deep hole drilling, and so on. Those kind of capabilities are very hard to find. And we invested long back and getting it delivered, to the entire supply chain. So what customer today looks at Omnitech is that, we are adding all the different processes and different uniqueness into our facility and capability, which is driving them closer to us and giving us more and more SKUs of what their business is all about. So that's how we create that uniqueness in our business.
Adding to Bhalin's point, there are some engineering. We have a strong engineering team who works on around more than 30 people. Work on highly skilled engineering team who creates the process engineering, which allow us to maintain up to 5 microns of the accuracy on the job. So all the qualities and the accuracy are purely depend on the process engineering.
Okay, fantastic. That's great to hear. Can I ask a couple more questions, or should I get back in the queue?
So from our end, you are most welcome, sir.
Right. So, I mean, you mentioned the special capabilities that the business has. If you could help us understand the growth drivers, because certainly the end market in terms of the oil and gas equipment is not growing at the pace at which we are growing, right? So how should I think about the reasons, for your growth, and what should be sustainable order book growth from here on? You mentioned 30-40% revenue CAGR for the next few years, but if I have to think about the growth drivers and what is really causing us to sort of gain more wallet share with these customers, what would be, those top 3, 4 reasons?
Yeah. So, we have if you see our revenue, it is a quietly diversified revenue. So motion control and automations and industrial equipment along with the energy that are driving overall growth. But apart from that, in the energy segments, we are also, as per our strategies, we are also growing in the on the other side of like renewables and gas turbines and similar like that. So apart from O&M side, we are also growing into the other energy side of the business and along with the existing segment which are motion control, automations, and if you see in the overall absolute numbers, we are growing in that segment also.
Okay.
So can you hear us?
Yeah.
Roman, any follow-up question?
Yeah. Just thanks for that answer. Just one final question. Can you help us understand the supply chain of these products that we make? Who are our competitors globally? If you could just name a few of the top competitors, that would be helpful.
Yeah. So we are mainly or many side we are also competing west side of our supplier base. Like a customer, if you see our customers are a multi-billion dollars of customers. So what we are trying to do, many of the critical product and assemblies, we are replacing the west side of the suppliers like US suppliers, Mexico, Canada, and similar regions, apart from some of the European countries. That supplier we are trying to replace into by developing a different capability in the Omnitech. So that's the overall our. But in the many outside in India also, some of the players are having some common customers where we are presently working.
Would it be possible for you to name the customers that we are gaining market share from?
Yeah.
Maybe
overall. Yeah. So if you see, just example, Siemens and Baker Hughes, they are just presently our common customer with Azad. Weatherford is a common customer along with the MTAR. So this is just a high level of that. And in the Pune, there are some oil and gas like some Ultra Corpotech. They are also competing us in the certain segment. So if you see our customer base, so there, like in the coming to the Azad, MTAR, Ultra, we have a different customers we are competing in a different area. So in the Baker Hughes, there are OFSC side, which are the oil and gas side and similar like that. But Baker Hughes has also the gas turbine business. So we are also competing in the many of the segments and many of the areas. Customers are also having a pain which they want to mitigate the concentration of their supplier base, and like they have with one supplier they have a they have already reached to a one very good headroom, and now they have to mitigate the risk of the concentrated supplier. So that is also leveraging us to grow much faster into that customer. And so these are all our common customers. And these are very few, but apart from that, we have Emerson. There we and Ultra is competing in the airport ground support equipment. Oscos is there. There we are competing. So you can say large level, Azad, MTAR, Ultra, more or less they are competing us in the large customer base.
Okay. Sorry, one final question. If you could give us from the energy segment, end industry-wise mix, let's say how much is gas turbine, how much is O&M, etc., etc. If you can give any broad numbers on that, both in revenues and order book if possible.
So presently, as we have mentioned into our our presentation, these are the energies, but it is also having some portion of renewable, some portion of other energies and similar like that. So as per our presentation, 54% comes from the energy and 27% comes from motion control and automation, and industrial equipment is around 16% and something like that.
Thank you. Shomil, may I
And
please be joined back?
adding to in this point, as we are having a diversified portfolio, which are enable us to grow much faster as compared to some of our peers, because we have a 3-4 segments where we are already existed since so many years. Apart from that, we are also growing into the defense side of the business.
And one more thing what I would like to add here, this is Bhavin, that on a large part of the energy, we are on the operation and the maintenance side, as what Uday bhai said earlier, and we are not more on the exploration side. So that also point you need to consider, that it's all repeatable business.
Perfect. Thanks a lot for answering all my questions. Thank you so much.
Thank you so much. Thank you.
Thank you. Next question is from the line of Yom Daga from Valcor Capital. Please go ahead.
Hello, sir. Thank you again. This is regarding the 1,000 crore order we have from Weatherford. So I just wanted to understand how this order will be ramped up. Like how much revenue will we do in the first year, and then how will it be ramped up?
Yeah. So that order is having a timeline of a maximum 5 years. And what we are seeing overall, at present also we are already having a good relationship and good working with the Weatherford. So overall, every year there will be the ramp up plan, because we need to have a sufficient capacity to deliver that. And in the O&M side, in the OFSC side, all customers are very much bullish in terms of geopolitical situations like Venezuela situations, and there are some another you can see overall oil market. So we have taken around up to 5 years of time plan, but there is a staggered ramp up plan: first year, second year, third year, and like that.
So how will that split look like?
So basically, it will start something from 80 to 100 crores, and it will eventually go to 250-300 crores.
Okay, sir. Understand. And will we need any capex for this order?
So there are two aspects. One is the capex capabilities, and another is the capacities. So we are well secured with all the capabilities. We are having more or less some of the capacity already existent, and we are with the IPO proceeds. We are also adding some more capacity.
So with that addition, we'll be through with this order, right?
Right.
And also, sir, if you can provide us a geography-wise split of our order book, like what percentage is from what geography?
So if you see in 9 months, geography-wise, it's 58% is North America, and some of 20 and 17% are from India and Asia and Europe. But as a strategy point of view, and thanks to EU deals, we are also significantly growing into the Europe market and some of other regions like Singapore, Indonesia, and similar countries.
Okay, understood. And sir, what would be the EBITDA margin differential in, let's say, a domestic order versus an export order?
See, our pricing structures remains same for the global customers, as we are a global supplier category. So pricing remains same. There will be some in India and US, but there may be some currency difference of that. In India, like Weatherford, I have a plant in India, so we have to calculate some of average of the quarter of the currencies, and we have to give the price in the INR. That's only the difference.
Thank you. I'll request you to come back for a follow-up question.
Okay.
Thank you. A request to all the participants, kindly limit your questions to two per participant and rejoin for a follow-up. Next question is from the line of Poojan Shah from Molecule Ventures. Please go ahead.
Thanks for the opportunity and congratulations for great set of numbers, Uday sir and Bhavin sir. So my first question pertains to the working capital. So I understand that we have reduced the working capital by the IPO proceeds, but just want to understand in a broader aspect, what are we ideally expect in terms of working capital range it should be there, and how we look with the order book of currently at 2,900 crores, how we see that working capital will shape up going forward?
Yes, Paras.
Yeah, this is Paras. From the working capital side, if you will see, then in this, we have earlier last year it was 283 days. Now it comes to 56 days. So as we continue to scale and progress on the progressively optimization, the working capital days are coming down. And it is due to the process alignment, tighter controls, what we are doing in the operational efficiency.
So if I want to break up into the inventory days, so can you just give a split in the broad between how much is the RM inventory days and how much is the finished good inventory days?
Yeah, if you will see the overall, if I say about the inventories, then there is some MOQ that we need to buy from our suppliers. For example, if we require a material of 1 ton, then as per the MOQ, we need to buy the 5 tons of the material. So if we see, okay, for example, in the last financial year, there was one customer who is doing the X revenue, but now in this financial year is doing X plus Y revenue. So if we see the inventory days, then we mitigate the MOQs from 1 ton to 5 tons. So once we ramp up the business and the revenue from the customers, it will go down. But if we compare the inventory days from the last year, then it's quite decreasing more.
And adding to Paras' point, there are many of the parts are having a safety critical in the nature. So we have restrictions from the customers. We have to buy from their approved supplier base or approved vendor list, and that is also making us that. But as we are ramping with that customers, which enable us to revolve our inventory much faster.
Right. And just to understand a broader picture on this Weatherford order which we received right now. So just want to understand how the procurement cycle from the Weatherford works. So basically, how long duration do they able? First of all, do they pass a minimum order? Then they try to quantify certain qualities and quantification on that part. And then how we get approved and we refrain the competitors to remain a key supplier to Weatherford. So just if you can simplify the process, it would be much helpful.
No, perfect. So basically what happens is that what we said earlier, that we give, a lot of process engineered value to the customer, where we give, a lot of solutions to them. So first and most important point is that how much value added product line we can give to any customer to that matter. And of course, Weatherford is one of our key customers in that particular aspect, that we are adding a lot of value in terms of whatever parts they are giving. That means that they are giving us just a machine component. They are also giving us certain components which has an API-based certification requirement, which not many of my peer companies would be having that. There are a lot of product lines which also have special surface treatment requirements, which people can do it, but they will have to probably do it from some third-party source, which we do it internally. So a lot of these particular value chain what we have driven. So that is one aspect of it. As far as the offtake of the material from the customer side, there is a possibility that offtake is basically dependent completely from the customer end, as they can try to prepone or postpone within this particular 5 years, depending upon the market requirement. But what we try to do is that we have been able to pull in a lot of additional FA qualification, and this particular aspect has been going on since last 2.5 years, or probably a little bit more. So this is not a new development what we have done. This has been a constant, a strategic decision which we had taken probably 3.5 or 4 years back, which led us to this particular day where we have this long-term agreement where a lot of parts have been qualified. And usually what happens is that all the parts which have been, given to us would probably remain with us. And, the parts which would be developed with some other peer companies, that would be probably a new different product line which they would be probably working on. I hope I have been able to cover everything.
Pujan, I'll request you to come back.
Quite a detailed answer. Yeah, thank you.
Thank you. Next question is from the line of Raj from Arja Partners. Please go ahead.
Hello, am I audible?
Yes, sir.
Yes.
So in the interview, you had said a typical revenue mix would be in H1, we do 40% of the sales, then in H2, we do 60% of the sales, right? Then H1, we did around 230 crore sales, which comes to, I think, 550, 560 crore sales for the full year. Is the calculation right?
Can you repeat? There was a little bit breakage in the voice.
So in the interview which you gave on the TV, on that you said the typical revenue mix, 40% of the sales you would do in H1 and 60% of the sales will come in H2. So in H1 FY26, we have done around 228 crores of sales. So for the full year, can we assume around 570 crore sales?
That is generally the case, but it can be very specific years can be different year on year. So usually that is the overall trend, but it can also vary from year to year. So it's not exactly the same. It can vary from one year to another, but roughly it would be on the same line.
So roughly it should be same for FY26 as well, right? So we should cross around 550 crores or something like that.
Actually, in the presently, we have also capacity constraint also. In a certain product line, we have a more lined up order, but we have also in a particular machine segment, like just the example, we have a 5-piece machine. So many of our 5-piece machines are already booked. So there is some capacity constraint. There we are working on some bottleneck capacity resolvement.
Understood. Okay. And sir, how much of our energy sales would be via... Hello?
Yes.
Am I audible?
Yes.
So sir, how much of our overall sales would be directly to the customers and how much of it would be via distributors?
So our 100% revenue comes from direct OEM. So we work with direct OEM.
All right. All right, sir. Thank you.
Thank you.
Thank you.
Next question is from the line of Piyush Jain from Equin B Ventures. Please go ahead.
Hello, sir. Sir, can you guide us what is the general asset turnover in the business from a fixed asset turnover or a gross block perspective?
Yeah. So in general, when we are investing and when we are ramping up, we start from 1.2 and in general overall. But if you see before 3 years of the cycles and forward 3 years of cycles, it should be quite more on the asset turnover side. And again, it's again depends on the product mix. Like if there is the inconals and all the, depends on the material grades and everything. So, but we are overall at near to our peer.
So it will be in the range of say 1 to 1.5. At peak, it will reach closer to 1.5, and a stable run rate of say 15%.
No, it can be more also. So it is just the average. When we are ramping up, initially it will go some of on lower side, but when we reach to a good occupy stage, at a time we can do that. So ideally, it can be go up to more than 2 to in between 2 to 2.5 also. If you see before 3 years of the financial, it was there,
And on the similar lines, what is the general operating margin that you look at for any orders? So what would be the range, typical range?
Typical range, we operate in a roughly 33 to 38% in and around. And again, it depends on the volumes, it depends on the criticality in the nature of the product, everything. Like if it is assembly, there may be a little more,
Okay. And sir, so you guided in a general sense for a 30-40% growth, but would you be guiding a more specific figure, because you already have the order book with you, and more or less it would run on scheduled basis, correct? If I'm not wrong. So can we have more specific numbers for say March 26 and March 27 on the revenue front?
So adding to this, so we have not, what we have guided. Historically, we are growing on the particular sum of a good CAGR growth, and we are projecting we are hopefully we will achieve the nearby growth with the present situation of a geopolitical and something. So we will be in the growth trajectory, but world is overall in the uncertain market. So we are restricted to guide something, but we have a strong order book. We are having a strong positioning at our customer base because of oil and gas market, because of the energies and oil and gas. Many of the customers are same customer like a Baker, Siemens, and similar like SLBs and like that. So our positioning is well positioned into the market. So we are overall anticipating, and hopefully we will be there.
All right. Thank you so much.
Thank you. Ladies and gentlemen, we'll take that as the last question. And now hand the conference over to the management for closing comments.
So we would like to thank each and everyone, and we look forward for having a meeting next time again, and showing the same promise and making sure that we grow strength to strength. So thank you everyone for coming, and really appreciate the thing.
So thank you. Thank you so much, everyone.
Thank you all.
Thank you very much. On behalf of Equirus Securities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.
Thank you.
Thank you. Thank you.